welcome. And he runs our education committee, and he's a really sharp mortgage broker. But I printed this off, and it's got all kinds of words that I would never get right, so I'm going to almost read it. So Rick is the principal consultant of Equitable Consulting, a residential commercial mortgage company. As the principal consultant, he holds the roles of financial advisor, licensed loan officer, non-delegated underwriter, and private fund manager. And he actually defines those in his presentation tonight. So he's Director of Education for Georgia Real Estate Members. Here's what I wanted to get right. Member of the Atlanta Commercial Board of Realtors, Mortgage Bankers Association, Georgia Association of Business Brokers, and Terrace's team of Keller Williams Commercial. He holds licenses with National Mortgage Licensing System, Georgia Department of Banking and Finance, Florida Department of Financial Regulations, and Georgia Real Estate Commission. His motto, and I love this motto, his motto is, we measure success one satisfied client at a time. So without any further ado, here's Mr. Rick Girgis to tell you 7 ways to become a millionaire. 7 real estate. Expectations are high.
All right. So we're going to cover 7 ways to generate $1 million. Now, we're being deliberately vague with this million. It could be income, it could be wealth, it could be equity. We did that on purpose. We're going to have 2 owner-occupied real estate investment strategies, which are a couple of my favorites. Couple investor residential. Well, I changed one from a flip to a hold strategy. It's actually a matter of opinion whether or not it's a flip or a hold. We'll split hairs on that when we get to it. And then 2 commercial strategies and some hybrid, maybe a couple hybrids. So it took me twice as long to type this up as I had planned. So a couple things changed during the process. How long it would take to make $1 million in equity or per strategy, the requirements to obtain financing, and why some plans are better than others. Thank you all for coming. Glad you guys made it. So we're going to cover some brief definitions. Licensed loan officer is, since the SAFE Act, we've been required to be licensing, so we have a fiduciary responsibility to not steer anyone in the wrong direction. Non-delegated underwriter is one of the higher titles for underwriting. It means you can underwrite for a number of different agencies, companies, secondary market investors, Fannie, Freddie, FHA. A private fund manager is a director of a private fund. Wealth, for our purposes, is going to be measured in equity or real estate net income. Opportunity cost is your time multiplied by your hourly rate. Ability to repay, it's part of Dodd-Frank, it's proof of income with tax returns, W-2s, which has been expanded into bank statements, and that's a minimum that's required for all owner-occupied residences. Debt-to-income ratio is debt divided by your income. These debts are not any debts, just debts that report your credit. 45 to 50% is the max allowable tolerance. A general contractor is someone with general contracting experience for our purposes. Agency is VA, Fannie Mae, Freddie Mac, USDA, and FHA or HUD. FHA HUD is the same agency. Non-agency is not one of those. And PITI is monthly principal interest, taxes, homeowners insurance, and homeowners association if it applies. All right, I want you guys to download this app. It's a free financial calculator.
How about that one?
Thank you, Kurt. Looks like that. When you pull it up, looks like this. We're mainly going to use the TMV calculator. It's time value money. All right. So some concepts. Time value of money. Sorry about that. Let's read back, I think. Time value of money has 5 factors: present value, payment, future value, rate, and period of time. basis of economics, the law of supply and demand. Basically, a low supply and a high demand causes an increase in price. I think we're seeing that now in Atlanta. How many people in here have own their primary residence? Raise your hand. Okay. How many people don't own their primary residence? All right. Okay. So you can do this exercise at 5%, 6%. You can play with the terms. You can play with the present value. You can play with the future value. If you withdraw payments, that means you're drawing out an annuity. So those are the 5 factors of finance. Stronghold strategy overview. It's very safe, it's conservative, it's good for the working person because it's owner-occupied. Now, it does not mean that you cannot move. Many people move and participate in this philosophy, but you want to put in a goal or a plan that may pick up where you left off. Or a better plan, or you may get married and pick up an additional household income, or you may want to reduce your size. Okay, so let's take a look at the numbers for a $600,000 quad with
What's quad?
Good question, Kurt. Thank you for that. It's a 4-unit complex with $2,000 rental income per unit. 10-year loan at 3.75%. It's at 3.75% because it's a 10-year loan. It's actually a real rate for FHA. $600,000 quad has a principal and interest payment of under $6,000 PITI over 10 years. So that building will generate $6,000 in income. You'll have to come out of pocket for PITI, for taxes and insurance and maintenance, but in 10 years, your $600,000 quad, well, it depends on what it'll appreciate to. I've got to calculate that.
It'll be paid off if you want.
It'll be paid off. So what's the future value of a $600,000 quad at 4% interest? What's that?
$12, 12%, changing the period to 120.
That's 12% rate of appreciation?
Yeah.
Would make it $1 million?
Well,
So this is so in 15 years, conservatively, a $600,000 quad would be worth more than $1 million. Okay, 888 in 10 years at 4%. So this is a 12-year plan, but this plan has very little cost of living expense. Before I go to the home offer, do you guys have any questions or want me to elaborate on anything?
low living expense.
Because if it's a 10-year note and the principal, interest, taxes, and insurance are $7,000, the cost of living, the payment on that would be $1,000.
Because 3 tenants are paying part of your mortgage on.
Exactly. I'm going to put this in myself. Dollars at 5% interest, 5% rate of appreciation would appreciate to a future value of $988,205, close to $1 million. So this is a 10-year plan. I want to stand in front of it so I can block it. Okay? So this is a 10-year plan to $1 million with less of a cost of living expense than the single-family residence. I am a big proponent of quads. I love multifamily housing, 1 to 4. The numbers can make a lot of sense.
This is the strategy that I'm going for. I've never purchased before, so I'll be the first time home buyer. The owner-occupied stipulation, is it true that's usually only 12 months that they require you to occupy, or is it longer than that?
Okay. So, occupancy fraud is the #1 fraud of 2017 per the Dodd-Frank Act. For a property to be owner-occupied, you have to move into it for at least 6 months and 1 day during the first year. Okay? I wouldn't recommend anyone push the envelope, but if you move into it and you decide you want to buy another primary residence, which is the next strategy, you're free to do that, and your financing is non-negotiable. It's actually my favorite strategy. We're going to move past this one and go to the home hopper unless someone has an objection.
Frank, just a question. Can you explain on the prior slide, you had a $600,000 quad with a 1.5 over 1 DSCR. What's DSCR?
Debt service coverage ratio, and we're going to cover that a lot more when we get to the investor loans. So there's 7 of these. This is the second one. This strategy is called the home hopper. This is where someone buys a primary residence every year and moves to it. It maximizes your leveraging opportunities. It gives you an unbelievably low interest rate. Now, we're not going to get into taxes, but there's more than one way to show rental income. I don't recommend doing it on your Schedule E. I recommend using an LLC and a Schedule C or an 1120S, because it'll cause you a lot of problems, as Steve Loby can attest to, during the mortgage process if you utilize depreciation and depletion, which everyone's going to encourage you to, because it's going to count against you personally, but it's going to, you're going to have to more than double it to offset it to have a 50% debt to income ratio. So when you move from a property, you can transfer the title to an LLC. And if you do that and pay out of your LLC for a year, that falls under Fannie Mae's rule on continuity of liability, and it doesn't actually count against you even if it is reporting. But that is not a topic for today, to be clear. So $300,000 house every year and rents the non-occupied property at a debt service coverage ratio of 1.5 to 1. The investor would reach $1 million within an estimated 7 years and $10 million net worth within 30 years. All right, so we're not going to do a highly intellectual chart on this. I'm going to give you a dumbed-down approach. If each property of $300,000 is worth $1 million in 30 years, there's a rolling $10 million, there's a rolling $30 million net worth. 30th year from the, as the properties get paid off. So if 10 of those, so if all 30 of those collectively can appreciate to 10 million in 30 years, it's not really a, something that we need to break down into a detailed spreadsheet, but we can and we will at the class. So that's a rounded number that falls between 9.5 million and 10.5 million, that for the purpose of this explanation, we're going to just call it 10 million. Strategy overview. It's aggressive, but I liked it. more risky than a stronghold, but the bigger numbers always are. If you look at the numbers on this, for a $600,000 quad with $2,000 rental income per 10 units, at a 10-year loan at 3.75, I didn't even run them. They're going to be outrageous. That's something that we're going to do in the class. Limited GC experience is required. Pitfalls include loss of income, job, and loss of renters. There's going to be moderate opportunity cost.
Well, there's another one is the rehab. Every time a tenant moves out, usually rental homes they need, especially if talking about 30 years, you probably spend more on rehab than the original price you paid for those things. I can vouch for it myself.
Yeah, it's certainly a point of contention. So, conventional mortgage highlights. We've got Fannie Mae is the largest purchaser of mortgage notes. Approvals are typically 5% down payment, 3 months reserves for a primary residence, and 6 months for each investment. Freddie Mac has most of the same guidelines as are in the Fannie Mae Buyer's Guide. Except Freddie allows for 1 year's tax returns for self-employed borrowers. There is a condition that requires the business to have been established and in existence for over 5 years. But theoretically, you could have 4 years tax returns in the red, 1 year in the black, and qualify based on that last year's tax return. Freddie likes assets and isn't as partial to higher debt-to-income ratios. So you're more likely to get a Freddie Mac approval with higher assets and a higher debt-to-income ratio than Fannie Mae would be with a lower debt-to-income ratio and lower assets. Same loan limits apply. And here are the conventional loan limits. 1 unit's $453,000, 2 units $580,000, 3 units $701,000, 4 units $871,000. You can Google this anytime and pull all this up. Fannie and Freddie are. FHA is not. FHA is by county. So FHA has the 203B, the 203K, the home equity conversion mortgage. The 203B is a standard purchase refinance program. It's 85% loan-to-value on a cash-out refinance, 96.5% on a purchase. The 203K is a rehab program. There's the mini and the full. The mini is below $35,000 in rehab. The full is over $35,000, but it will. But you've got to be careful with it. You've got to have a HUD-approved counselor approve your budget, and you've got to have a licensed general contractor, and you've got to have a licensed general contractor with both. But the licensed general contractor and the HUD-approved counselor have to collaborate and approve your budget. That process alone can take a couple weeks, and you have to bear with that. But it is a great program, and it's a good rehab program. And if you find something that's really low compared to the after repair value, they'll allow you to not have any mortgage payments until the project's complete. So you can actually defer all the payments.
First, the issue of loans versus income. If you have got 5 or 6 or 7 income-producing houses, and they give you, for rent, they only give you 50% of the rent credit because they figure vacancies, whatever, because I've just gone through that. And if your income, your real income, is not enough, they don't give you a loan. So it's not like you can buy unlimited houses because you're stopped by the lender telling you you cannot afford any more loan.
Well, okay. So she's saying that you can't, I think your question is that there's problems with the way conventional loans review income, and you can't buy unlimited numbers of properties. So Fannie Mae has a restriction, you can only buy up to 10. That's correct. Now, the way the income is calculated is a combination of, it depends on how you show your income. If you have it being paid through a corporation, then it's the income of the corporation. If it's an S corp or an LLC, then it flows through to you, and there's no net effect at that point. Now, if you file a Schedule E, then we add back depreciation, depletion, mortgage interest, and amortization, and you're essentially counting the payment. You essentially have to offset the payment with twice as much in income.
What's the close timeline for the 203K loan, and especially if you're in the over 35,000 rehab budget?
So a lot of it depends on the borrower. How long does it take to get the HUD counselor and the general contractor to collaborate on the budget and send you an approval with a certificate? I've seen people take months doing that. I've seen people take 2 days doing that. From that point, I'd allow 60 days. A home equity conversion mortgage, great product for someone with low income and a lot of assets as a purchase. The cash out reverse mortgage is a good product for people that want to pull out a line of credit or eliminate a mortgage. It's also a foreclosure rescue program. There's a senior in distress and you want to tell them how to save their house. The reverse mortgage is a program for that too. These are HUD programs. HUD programs are designed for stabilization. Who's heard terrible things about reverse mortgages? Somebody tell me one bad thing about a reverse mortgage.
Expensive.
They are expensive. That's true. The upfront MIP is a lot, but that's what keeps HUD lucrative. HUD's got to keep the lights on. When they can't pay their bills, we're all in big trouble. But HUD's running at a surplus, and it's a good program for those in need of it. There are some common misconceptions. Nobody takes the house. Heirs have up to a year to redeem the property. So, non-agency, we didn't really talk about that. Non-agency is neither Fannie, Freddie, VA, USDA, or HUD. Their loan amounts go up to $3 million. They are the new subprime. Their credit scores go down to 500. We're not where we were 10 years ago. Everything's very common sense. Loan to values are very low. Everyone's running these things from a private hedge fund perspective or the perspective of an investor that doesn't mind taking the property back. We are at a very responsible lending era, and these programs are necessary to serve a huge demand. The lower income class have a lot of trouble getting loans. One of the biggest problems they have getting loans is Dodd-Frank made a 3-point rule restriction on fees, making that anything over 3% high cost. Who's going to do a $40,000 loan, charge $1,200, and your average loan officer's on a 1% comp plan? Thank you, Congressman. You made doing loans for the lower income class impossible by passing high cost regulations. Loan to values are lower on non-agency, 80 to 90%. We have 4 national programs and programs available for recent credit incidents. And this is industry-wide. Owner-occupied loan options, Fannie, Freddie, FHA, VA. and non-agency. Fannie allows full documentation only, 2 years out of Chapter 13, 4 years after Chapter 7, 4 years from a short sale. Freddie allows for 1 year's tax returns, same rules as Fannie Mae and the Fannie Mae Buyer's Guide. FHA, scores down to 580 as far as I'm concerned. You'll hear lower from other people. 3 years out of foreclosure, 2 years after Chapter 7, 1 year out of Chapter 13. 203K, 660 minimum score, 10% down, rehab loan. Reverse, no score requirement, low income requirement. VA offers 100% financing with lenient DTI, reserve requirements, same loan limits as Fannie Mae, and non-agency. Owner-occupied home mortgages up to $5 million with bank statements. They've redefined Dodd-Frank to include bank statements as proof of income. Case-by-case, common sense underwriting, non-warrantable condos, foreign nationals, bankruptcies are common sense, depends on what we're looking at.
Can you define bank statements? What are you talking about? Brokered statements?
So if someone wants to buy a $5 million house and their tax returns show they make $200,000 a year, we all know they make more money than that. So we can collect 12 months bank statements. If they're business bank statements, depending on the business they're in, we'll usually take 50% of their deposits. If it's personal bank statements, we can take 100% of their monthly deposits. That'll be enough to calculate their income. Do you guys have any more questions before I move on to investor loans? And there'll be a Q&A at the end if you guys have anything that come up. Residential property real estate flip strategies. Call this my Finding Nemo slide. So, it starts with finding the low buy. Everything starts with finding the deal. Often takes a visionary and market resourcefulness. A visionary to see what they're looking at isn't that ugly, what the lipstick looks like afterwards, and the resourcefulness to know where to look and how to look. So we had a success story earlier. I tried to incorporate it. That success story with a cost of living adjustment. If you do that 26 times with very high efficiency, you arrive at $1 million in 2.5 years based on her making $39,000 on that flip. Right? Now raise your hand if you think that's a very high probability of ever happening. Okay. So, loan amounts. Loan amounts on hard money loans are normally 90% loan to value, limited to 75% of the after repair value. 75% of the after repair value should not really come into place. If it comes into play, then I'm for one, I'm going to tell you that you probably shouldn't do the deal. Now more than ever, I've turned down more hard money contracts than I've accepted. It's always a good idea to have the seller pay closing costs. We charge the same thing on all our commercial deals, which is 2% plus a processing fee. Lenders normally charge another 2% to the fund manager or the private lender. So that's a total of 4% on a hard money loan. Rates are normally 12%. I think that's the next slide. 10% down payments required. Avoid niche products. You will run into some people that say they finance 100%. They do it even for new people. That's amazing. New people have the highest failure rate in hard money rehab loans. I mean, it's a great technique if you're actually a real estate investor, you know. But, you know, there are companies that offer some unbelievable niche products And if you go that direction, then I hope you're staying in there for the long ride and know that it may not close. Biggest cause of failure on a fix and flip is running out of money. Second cause of failure is running out of time. So if you have a job and limited funds, take some serious things into consideration before you go into this sort of a venture. Rates range from 9 to 12%. We'll fund the acquisition, we'll fund the rehab. So if you're looking to buy $100,000, if you're looking, I think that's my next slide, let me see. So if you're looking to buy a $50,000 property and you need $50,000 in renovation, I hope that it's worth at least $150,000 when you're done. And we're going to ask you to come to closing with 10% down payment, not to be confused with closing costs, which is not in that equation. So if seller's paying closing costs, it's still not in that equation. And 10% will get you through the deal. But if seller's not paying closing costs, we're going to charge 2%. Fund manager's going to charge 2%. The attorney, Georgia intangible tax, title insurance is going to cost you another $3,000 for that transaction. That'll be $17,000 cash to close it. And you still have to pay your taxes and insurance separately. They call it hard money because it's hard. Okay? But on the positive note, your 12% interest, you guys pick your battles. You should take 20% interest rate and no points if you're only going to keep it for 2 months. Because you're only going to make 2 monthly interest payments if this scenario pans out the way it did in this case. First phase is also the responsibility of the GC. A lot of people try to do their own general contracting work. Well, if you don't have an account with Lowe's or Home Depot or a way to carry that load, that's your responsibility for the first phase. There's no income required, but we do collect tax returns to make sure that you pay your taxes because the IRS's lien supersedes ours, and we don't want to see anyone in a bad situation. Pitfalls. Extensive rehabs are risky. The more rehab, the riskier it is. Be honest with yourselves about your experience. Save yourself cash at closing by having the seller pay closing costs when possible. Don't run out of money. Plan your time well. We saw the success story at the beginning. So, this is going to start getting more interesting now for your more seasoned investors. And I'm excited for you. The measure of success for a hard and fast flip. What's the cash-on-cash return? Okay. So if I'm going into a rehab, if I'm going into a flip, how much cash am I putting into the deal? How much cash do I pull out of it? You're making fun of the students. All right. So if 10K can be turned, I corrected the wrong thing. So if you turn $10,000 into $40,000 in, there's a typo there. Steve pointed out. He's a mathematical genius. That's why I got you all calculators. So someone else can correct me besides Steve. It gets exhausted when it's just Steve correct. If you turn $10,000 into $40,000, that's a 300% return. Okay? In 2 months. So in 1 month, it's 150% return. In a year, 1,800% return on the year. Cash-on-cash return on investment. That's phenomenal. If you can do that on a regular basis, come see me. You can have everything I own. Just go play. How much time was invested? What's the opportunity cost? So if you normally make $100,000 a year, and your projects make you $80,000 a year, your opportunity cost is more than your investment gains. something to keep in consideration. Your hour, your time is your opportunity cost. Very few people track that. If you can double your cash while maintaining a reasonable lifestyle, you're a success as far as I'm concerned in the hard money game. High income flippers are working the $400,000 to $800,000 price range and selling one home every 6 months. The people that are killing it, that I see, that I work with, are in a bigger price range, and they do other things, and they're making an average of $100K per property. But they're spending a lot of time looking for properties.